We start with the global concern over inflation in a week that gave us new CPI numbers and Chair Warsh's first testimony on Capitol Hill. Are we facing higher long-term interest rates? How much of it comes from that AI rush? And what does it mean for Western economies if we can't get back to that magical 2% target? Loretta Mester was president of the Federal Reserve Bank of Cleveland and now holds positions at both Penn's Wharton School and Princeton. We got new inflation numbers out this week, which were not as bad as they had been in the past. But there has been a growing concern, I think, about longer-term inflation. Where are we?
Well, inflation's been above the 2% goal of the Fed for over 5 years, so we do have an inflation problem. I think it remains to be seen whether where interest rates are today are enough, right, to actually move inflation back down. I think the question that FOMC is going to have to ask itself is, do we need to raise interest rates a bit in order to add restrictiveness to the economy to bring inflation down? And I think they don't know that yet. I think the tone is getting more that we're impatient with this inflation, but I think they're going to wait for some more data before they make up their mind that they're going to need to raise rates. I think there's a good case for saying we need higher interest rates, because it's hard to argue that where we are today is very restrictive on the economy.
And particularly maybe because the headline number came down really largely because of fuel. Really,
yeah, that's right. I would say, though, that overall the report was a pretty good report, even when you look at the components. I mean, one of the things that have been, I think, troubling me is if you look at core services excluding housing, and I think that's a key indicator to look at, that's been moving up. Right? We had the inflation coming down last year. Even before the war in Iran, we saw that indicator, the services component, excluding housing, starting to move back up. And I think that's got to be a concern for the FOMC. You know, they've been forecasting inflation is going to come down, and even without oil prices pushing it back up, you still see that inflation's been pretty sticky.
And so it raises the question for some of us, why? I mean, it's good to have the numbers, know where the numbers are, but then you want to know what is really driving that, because you have some sense of where it's going to go next.
Well, I think that's the question about how restrictive really is policy, right? And monetary policy is what's going to determine whether demand is outpacing supply and therefore putting upward pressure on prices, or, right, whether it's restricted enough and it's going to bring demand more into balance with supply. The
one place where we know demand is up is in AI and all that comes with it. All the investments being made are really, to me at least, stunning. Does that in and of itself suggest that we probably are going to have continued inflation pressure for the foreseeable future?
Well, you certainly see prices for components that go into AI being elevated, and that is a source of pressure, upward pressure on inflation. I think the question, and this is something that the new chair, Kevin Warsh, has been talking about, is eventually he believes that AI will increase productivity enough that it becomes sort of a disinflationary force. I don't think the timing really suggests that we're going to get there soon. I do think right now it's an inflationary issue, and the question is how long will that last, and whether, again, that'll feed into other parts of the inflation and the consumption basket and therefore become a more of a broader inflation problem.
And this week we had not just the CPI numbers, but also Chair Warsh with his first appearance on Capitol Hill, where, to my hearing, said we really are serious about this inflation. And he recognized what you said, which is we've had it over 2% for a long time now. We've got to do something about that. At the same time, maybe, as you said, eventually it might come back down. How does he balance those two things? And how long is eventually?
Well, this is always a question for the Fed. And certainly, I think it was great that he reiterated the commitment that the FOMC and the Fed has to 2% price stability. I would say, as someone who was at the Fed, right, we were always committed to the 2% inflation target. That's not, and price stability and maximum employment, which are the goals that we've been given by Congress. So that isn't new. And the real question is, in making those trade-offs between the two goals, when there are trade-offs, right, and I think they're going to have to take seriously whether their policy rate right now is in the right place or whether they're going to have to recalibrate that a bit higher to get inflation down.
As you said, there's a dual mandate. It's both about price stability as well as employment. Does the nature of the employment situation in the United States right now actually give the Fed, if they wanted to use it, some room to raise rates some?
Well, if you look at the labor market, it's an interesting labor market in the sense that it does appear to be pretty steady and in balance. I think what troubles people is when you look at the rate of payroll employment growth, it's much slower than it had been in the past, right? It used to be that you'd say to keep the unemployment rate stable, you would need 150,000 jobs added per month. Now, right, that number is much lower, right? Many estimates are between 50 and 70,000 a month. So that's quite a bit lower. And that's because the supply side of the labor market has changed so much. So you don't need as much hiring to keep supply and demand in balance. So there's a lot of concern about the labor market in terms of those lower growth numbers, but actually it's been a pretty stable, and the unemployment rate itself is low. That doesn't mean that there aren't problems in the labor market in terms of different aspects of it. As probably you know and your listeners know, right, young college graduates have had to struggle to get jobs. Part of it may be AI, part of it may be uncertainty about the economy, but a lot of what's happening in the labor market is on the supply side, not on the demand side. And so yes, if the key concern right now in the economy is the inflation part of the mandate, not the labor side.
You mentioned the various task force, 5, I think there are, that Chair Warsh has named to deal with various aspects. I suppose it's sort of to be expected that when somebody comes in, they want to take a fresh look at things. Were you surprised at how quickly and how extensively he's looking at some basic things at the Fed?
Well, not really, because he was very vocal before he became chair about some of the things that he thought could be rethought. Right. And so if you look at the task force, there's one on communications, there's one on the balance sheet, and he's been very vocal about the balance sheet and the use of quantitative easing. He's been very vocal about trying to find data sources that are more micro-oriented data sources and more forward-looking to help the Fed do its projections so that it can have a better sense of where the economy is going. And the last one, of course, we just talked about AI, the labor market. And he has particular views on that. What I was happy to see is that the people he's chosen as leaders of those 5 areas, they really are experts. It's a combination of academics, central bankers, not only U.S. central bankers, but abroad, who have been central banking experience in terms of actually doing monetary policy, and some business leaders. So I think the combination of those people, right, and with the staff help from the Fed, as he said, right, I think we're going to get some very thoughtful results from that. And of course, then the FOMC will have to take up some of those recommendations and debate them among themselves because they are the policymakers.
Recently, the projections based on the markets have changed a fair amount about the likelihood of a rate increase. For example, in July, it really has moved around a lot. You've dealt with this for a long time. Is that typical? Have you seen that before? Is this unusual that the expectations are changing fairly rapidly?
Well, I think the economy has been changing, right? It's hard to read an economy where you had the tariff shock, right? Then we had the Iran war and the oil price shock. So there's a lot of uncertainty about what the trajectory of the economy is going to be. And of course, the on again, off again, Iran war, the ceasefire, right? That adds to sort of uncertainty because oil prices are a significant input into a lot of parts of the economy. So I'm not sure that I would say that it's more volatility than what should be expected given the uncertainty we've been facing in the economy. And then layered on top of that, of course, you have a new Fed chair coming in.
As you say, for several years now, we've had an inflation problem. And one question is, will it solve itself or do they have to get more restrictive? But from your perspective, do you think that the degree of that problem has changed over the last 6 months, 9 months? Is it a bigger problem today than it was 6 months ago?
I think it's a different problem, right? I think 6 months ago, the focus was on how much of the tariffs were going to feed through to inflation. And remember, there was also some concern on some of the committee members, right, about the labor market. I think the labor market is stabilized, and I think they have a much better view of sort of the low payroll numbers, not necessarily meaning the labor market is weakening appreciably. I think there's recognition now that probably the tariff part of the inflation story is stabilized, right? There's not going to be much more pass-through of that. We do have the oil price shock now, which is a new shock. But I think there's more recognition of the accumulation of bad readings in terms of inflation moving in the wrong direction, that I think that's really what's changed the narrative about inflation. I think there's better recognition that even though we're hoping that we're at a point where interest rates are enough to get inflation back down to 2%, that projection may not come to pass. And I think that's what's changed.